Welcome to Think Learn Finance. Today's video is all about regular investing. By the end of this video you will take away the following. What regular investing is. How regular investing works. The benefits of regular investing. And, putting it all together. What the hell is regular investing? Regular investing can be summarized as the practice of investing an amount of money at regular intervals, rather than investing a lump sum all at once. For example, this could be monthly payments from your wages into an investment account of your choosing, which then automatically purchases investments that you have defined. How the hell does it work? Regular investing can be set up in a number of ways. In some countries, it can even be set up directly through your employer. However, for most people, you will find an investment platform that you like that also offers regular investing. This is also sometimes referred to as regular savings. Some companies do not have a special name for it and simply provide the ability to top up your account via direct debit. You set up an automatic payment for an amount of your choosing and select the investments that you want to be purchased after the payment has been collected. It is as simple as that. You are free to cancel, pause or change your amount and investments at any time, but be aware that there may be a cutoff period where it becomes too late to make a change because an action has already been sent for processing. Please see your individual platform rules for these. There are lots of benefits to investing on a regular basis. It is also a good starting point for a lot of new investors. We will go through some of those benefits now. So, what the hell is pound cost averaging? Pound cost averaging is when an investor purchases an investment at regular intervals, regardless of the price. This means that when the price is low, they will receive more shares for their money, and when the price is high, they will receive less shares for their money. As a result, this can reduce the impact of volatility on the overall investment, and over the lifetime of their investment journey, it is possible that they can average a better cost for purchasing that investment than if they had tried to time the market, or purchased a single large lump sum of shares. Let's go through an example so we can see how this would work in practice. If we look at the table titled, Regular Investing and Pound Cost Averaging, we can see that, over the course of 5 months, an investor purchased 5 individual lots of £100 shares. The price of their investment fluctuated each month, meaning that the investor got more shares for their money in some months, and less in others. Over the 5 months, £500 was invested and the investor averaged a cost of £1.51 per share, and they received a total of 328 shares. If we compare this to the second table on the right, titled, Single One-Off Payment, we can see that pound cost averaging would be an amazing deal, if we compared it to an investor purchasing a single £500 lot of shares at £1.67, which our first investor also purchased at, but only for a smaller amount. A single £500 purchase at £1.67 would have only returned the investor 299 shares. However, a well-timed single £500 purchase at £1.45 would return 344 shares. It should be noted that, timing the market is extremely difficult and unpredictable, meaning well-timed trades are few and far between, with repeatable results often being unachievable on a consistent basis. Another amazing benefit of regular investing is compound growth. What the hell is compound growth? Compound growth in basic terms is growth on top of growth that you have already achieved. Let's use the table below to explain this better. For example, if you had £100 in your investment account and you made a return of 5% in a month, you would have £105 at the end of month 1. At the start of month 2, you deposit another £100. You now have £205. Let's say you make a 2% return this month, you would now have £209.10 at the end of month 2. Again, at the start of month 3, you deposit another £100, bringing your total balance to £309.10. For the example's sake, we will assume the markets were volatile, but you did okay and got a return of 8%. Your final balance at the end of month 3 would be £333.82. It is possible to see quite quickly how compound growth has an effect on portfolio value, simply by the regular deposit of funds and an average market return. This works by effectively growing your pot of money incrementally, while it is already working for you within the market, hence, growth on growth. This can be a useful strategy for capital appreciation. However, with everything in the investing world, there are risks, and good portfolio management, diversification, and investment selection are also key to overall success. Speaking about diversification. What the hell is diversification? Diversification is the process of spreading your investments across various companies, sectors, countries, and classes in order to reduce risk. Now you may be wondering, how does this tie in with regular investing? Regular investing can help investors achieve this goal. As mentioned earlier, you are free to amend your investment instructions at any time, meaning you can select new investment choices for your money. Some investors like to invest based on stock market cycles, others like to review their investments on a quarterly basis. This means every 3 months. While some simply check in once a year. It is completely up to the investor and their preferences. The freedom and flexibility is there for all types of investor to use as they see fit. This allows investors to maintain the consistency of regular deposits into their portfolios to help build their value and save money, but also allow them to periodically change the assets that they purchase so they form a diversified portfolio at the same time. Meeting long-term goals and managed investments. Regular investing can be used to meet your long-term goals by introducing consistency and structure to your investment and saving strategy. This can be key in achieving your goals. It is also possible to invest into actively managed funds or index-tracking funds, depending on your goals, which allows investors to reduce the risk, expertise, and resources required to reach their targets. This does not mean that investors can cut corners or skip steps in their investment journey, but it does mean that once an investor has found a suitable fund, with knowledgeable management, that they think they can trust, they are then able to let these professionals do a lot of the heavy lifting, so to speak, on the investor's behalf. Regular portfolio reviews will still be required, however, this will be a fraction of the time and effort needed compared to an equity-based portfolio, run by a single investor. Naturally, the costs involved and the returns available to you will differ between creating your own portfolio and investing in a fund. Always do your own research, as the two approaches vary greatly in the amount of risk you will be exposed to. We have covered what regular investing is, how it works, and the benefits it has. We will now look at how should you use it. This will be different for each person, but in simple terms, the process can be explained in the following steps. Firstly, you will need to consider how much you can afford to contribute on a consistent basis, either from your wages every month or from spare money you might have. It is important to not exaggerate this figure. It does not have to be a large amount. What is important here is consistency and not size. Secondly, you need to work out what you are trying to achieve. Is it a specific amount of money, for example? This will help you solidify your idea into an achievable goal to aim for. Thirdly, you will need to make sure you understand how much risk you would like to take, and make suitable and safe starting investment choices based around your own personal risk appetite. This is an extremely important step. You need to be comfortable with the amount of risk you are taking. If you would like to learn more about risk, then please check out my other videos, as I will be doing videos on this topic in great detail and how to manage it. You will also want to start thinking about your ongoing investment strategy at this point. Fourthly, you will need to pick a platform provider that offers everything you require, including markets, platform features, suitable charges, and so on. Next, you will need to set up your regular investing payment and investment instructions on the platform of your choice, making sure to fully read through all documentation you are provided with, and ensuring that you are comfortable with your own decision to proceed. Lastly, you will want to monitor your portfolio and strategy in accordance with your planning and research, adjusting where necessary. If you learned something from this episode, please hit that like button and subscribe. Don't forget to check the bell icon to be notified of our new videos. And remember, not everything that shines is gold. Catch you in the next episode.